Many thanks for joining us on Business Now. I'm blessed. I'm Anusa. Now let's get the news head on. The Senate has said it will squeeze some officials of the Central Bank of Nigeria on how the 30 trillion naira ways and means was obtained and spent by the federal government during the past administration of President Muhammadu Buhari-led administration. The chairman of the Senate Ad Hoc Committee, Senator Issa Jibrin, who made this disclosure in an exclusive interview with newsmen, also revealed that the panel would commence the probe this week. The Senate on Tuesday appointed Jibrin as the chairman of the panel to probe the 30 trillion naira ways and means loan released by the then CBN governor, Govt to the Buhari administration. The ways and means is an overdraft taken directly from the Central Bank of Nigeria to fund budget deficit or address national contingencies needs. This usually follows the approval of the executive arm of government and is meant to be ratified by the parliament. The National Institute of Credit Association has called for a credit system that allows students and players in the informal sectors to access credit for their education and scale up their businesses. In a statement on Sunday, the body charged with control, supervision, and regulation of the credit management profession said that a country that promotes a viable consumer credit system enables individuals to buy goods, assets, services on credit and pay later. Chief Executive Officer of NICA, Professor Chris Onalo, said a developed credit system would reduce cash transactions by enabling individuals to borrow to finance exigencies and other cogent projects, thereby helping to stimulate domestic production and foster economic growth. Onalo added that access to credit for that segment of the economy would enable them to feel the impact of the economy more. And now to capital market related stories. Investors in the equities market in February lost about 1.55 trillion naira over high yields in the fixed income market. The hike in the monetary policy rate to 22.75% is also expected to further drive interest away from the capital market in the short to medium term as investors seek better yields. The Nigerian exchange opened February with all share index and market capitalization at 102,802.25 basis points and 52.26 trillion naira respectively. It closed at 99,908.30 basis points and 54.71 trillion naira, marking a 2.75% decline. The researchers at Cowrie Asset Management Limited in their weekly market report also projected that the hike in MPR would slow the flow of funds into the capital market. On a week-on-week basis, the local bonds recorded a significant dip as the ASI declined by 3.27% to 98,751.98 basis points. The market sentiment was largely influenced by weaker than expected corporate earnings, releases, and initiation of the dividend earnings season in the face of the fixed income market higher yields outlook. A report on the assessment of progress on regional integration in Africa said the African share of global trade remained at least less than 3%, driven largely by merchandise trade in 2023. The report by the Economic Commission for Africa showed that African nations still engage in more trade with countries outside the continent than with each other. It also showed that despite progress in monetary and financial integration, member states had not met the macroeconomic convergence criteria despite progress in regional integration. To other news now, the federal government has announced a 90-day window to regularize import duties on specific categories of vehicles. The National Public Relations Officer of Nigerian Customs Service, Abdullahi Maiwada, disclosed this in a statement on Sunday. The development came amid rising number of detailed vehicles as foreign exchange crisis continues to make payment of import duties payments difficult for importers and firms. Mayweather said that the latest development was a proactive move to enhance compliance and streamline import processes. Recall that the NCS in February said it intended to grant waivers to vehicle owners to pay duties within a specific time frame to avoid sanctions. Speaking further, Mayweather added that the initiative applies solely to vehicles imported into Nigeria where the requisite custom duty had not been fulfilled or vehicles are detained due to undervaluation. He, however, explained that vehicles seized and condemned would not be released until that initiative reflects the service's unwavering commitment to facilitating compliance. Now, no fewer than 40 million telephone lines were barred by telecommunications operators over the weekend following the expiration of the February 28, 2024 deadline issued by the Nigerian Communication Commission, mandating telecom consumers to link the subscriber identity model, that SIM, to their national identity numbers, NIN. This represents a 28 million increase from the 12 million telephone lines initially planned to be deactivated by telcos following the NCC directive. In a December 2023 notice, the NCC had asked telcos to bar SIMs that had not been linked to their owners' names by February 28, 2024. On Thursday, the NCC Director of Public Affairs, Ruben Moka, ruled out an extension of the deadline, warning that telcos that failed to enforce the deadline should be sanctioned. However, on Sunday, the Alton chairman revealed that the number of barred lines had risen to 40 million, pointing out that SIMs without NIN were included in the number. The Nigerian Employers Consultative Association has warned that the Ministry of Interior's expatriate employment levy would deter investment in the country. The association also faulted the levy, saying there would be a need for certain regulations to be put in place before such tax could be imposed. NECA in a statement noted that following the launch of the Expatriate Employment Handbook, an initiative of the Federal Ministry of Interior, purportedly aimed at enhancing skills transfer in Nigeria, the new levy would frustrate the government's ongoing monetary reforms if implemented. Director General of NECA, Diwali Smart Oyerinde, explains that the move will serve as a disincentive to foreign direct investments amongst many other unintended negative consequences. The levy of between $10,000 to $15,000 on employers that employ expatriates when Nigerians actively seeking FDI is not only exploitative and extortionist, but also a contradiction that cannot be explained. Meanwhile, in his reaction to this development, business and public affairs analyst Charles Fakruha, while speaking on the subject matter earlier today on iBrand Television Business Breakfast, expressed serious concerns about the unintended consequences of the additional EEL, adding that the timeline for its compliance is too short. As a result, he appealed to the government to review the policy and undertake broader consultation with critical stakeholders to avert setback for the continental economic integration vision.
Well, one will say that there was no proper collaboration or consultation or engagement between NECA and the federal government via the Ministry of Interior. Yes, if you look at it, both parties have their concern. Federal government on one hand is saying, yes, expatriates are working here, we need to regulate. You know, if there are jobs Nigerians can do, why get the expatriate? And okay, if you have the expatriate and it's a non-direct job, please you have to pay this levy, the director you pay this levy, and they gave duration so that at the end of maybe a 10-year period, the expatriate will have been able to transfer that technology or expatriate to Nigeria, because Nigeria we are facing a lot of unemployment issue. That is the federal government on one side. At the same time, federal government want to attract FDI to come to the country, and that's where NECA is saying if we engage expatriates to work for us, it's another body for us to pay this amount of money, and of course some of the fines that will be paid if certain regulations are not being met. And NECA is saying there is a conflict between federal government trying to attract foreign direct investment and at the same time trying to see that unemployment, you know, Nigerians get employment in their country and learn or been trained by these foreign expatriates. Yes, but for me, I believe there could be a balance. You cannot just leave your economy, private sector, for people just to come in like that. There needs to be some form of regulation, whether you are attracting FDI or not. I also see on the part of NECA, to say, look, if we're employing this expatriate, it's because there are no Nigerians who can do it. So there needs to be a balance. Yes, I believe that federal government needs to regulate the employment of expatriates in our industries. And at the same time, as we are trying to attract FDI, yes, we should make everything easy, conducive for them to come, but that does not mean that we will just open our doors and even the job that Nigerians can do, they will give it to this expatriate. So for me, I think it's more of collaboration now